Hello and welcome to this preview for the Bank of England's quarterly inflation report, which is expected to be a much more market-moving affair than what we saw from the interest rate decision last week, where they kept rates at the historical low level of 0.5%. In terms of this November release from the Bank of England, the last time we saw a core inflation report was back in August. So conditions have changed fairly significantly since then, and we've seen somewhat a deterioration in the economy in terms of various UK data points, most namely as well headwinds and the potential ramifications that slowing growth in the Eurozone and generally weaker data there, as well as easing policies coming out of the ECB, may well prompt the Bank of England to look to push back expectations of the first rate hike in the UK well into the second half of 2015. Taking a look more specifically, we have seen mortgage approvals as well started to peter out from their multi-year highs that we saw on the back of the introduction of the Help to Buy scheme, since the FPC have embarked on these more tighter and stringent mortgage rules. And as such, then that's taken a bit of the heat out of the housing market, which was booming in the UK economy back in the summer of this year. And looking for a more dovish tone then overall to come from the Bank of England, an outside, more dovish viewpoint would be if they were to change their prediction of the amount of slack in the economy, which may well be seen as more rather than less, given, as aforementioned, the conditions at the moment in the UK economy, but also as well the slow growth, as what we've seen in the US non-farm payroll report on Friday in wage growth is of key concern to several MPC members, until they yet to see consistent and solid increasing growth in wages, and it's unlikely that they're to embark on any interest rate rises in the near future. So in terms of this overall report, we are looking for it to have a more dovish slant. Again, it could well be that the market may well price in some sterling weakness and flattening of the UK curve if they were to go as far as downgrading that in terms of their expectations of how long it will take to see sustainable wage growth, as well as their amount of slack they see in the economy. Broader expectations are more for the fact that they were likely to cut their GDP forecast, as well as inflation, with the CPI running well below the mandated 2% target at the moment. That's pretty much it though for me here for the moment, so I wish you all good luck on the event and have a great trading day. Thank you.